Good morning, gang. Happy Monday. Who knows what today's going to bring? It's about 4:45, and like a lot of people, I probably couldn't sleep, wondering what the hell's going on. So there was some interesting information that came out last night, probably 9:30, 10 o'clock, and I really didn't feel like putting up the video then because I figured more stuff could happen overnight. I wanted to see how the markets were reacting, et cetera, et cetera. So I waited till this morning. Yeah, okay. So what was it? Yesterday's video, I said, expect a bank bailout. And sure, what happened? Janet Yellen was running around the Sunday morning news programs, right, going, there's no bailouts. We're not going to bail out the banks, yada, yada, yada. And a few of you guys emailed me that, and I had seen the story. And as my comment was, do you trust Janet Yellen? I don't trust her as far as I can spit. Okay, because this is the woman who coined the term. What was it? Inflation was transitory. That was 2 years ago. Or the economy is strong. Really? Okay. Yeah. Okay. So after running around Sunday morning's news shows saying there's no bailout happening, no bailout happening, at 9 o'clock last night, the Fed bailed out Silicon Valley Bank. Okay, and I love the comment in their article that the taxpayer will not be on the hook for this bailout whatsoever. Now, somebody remind me again what profit the U.S. government makes. The U.S. government is funded by one thing: taxes. It's not making any money, it's taking money. Remember the old saying, makers and takers? The government is a taker, they are not a maker, okay? So the only way they get money is, a couple of ways. They can take it from the taxpayers, which would mean we're funding this. They could borrow it from China, which means we're funding this. Or they can print more money, which is probably what they're going to do, which means we're paying for this in the era of more inflation. Okay. CPI numbers come out this week. Those ought to be very interesting to see what happens, especially with how the Fed can handle this. Now, there's so many things to talk about here in this whole thing. So what's going on with Silicon Valley Bank, first off? Well, HSBC came out and said they are buying the UK operations of Silicon Valley Bank. So they're trying to shore up the debacle that's going on. I mean, the UK financial market's in turmoil because of this. Okay? Not that the US is doing a whole lot better. Okay. But at least they found a buyer in Great Britain. Yellen was so optimistic yesterday morning that they would find a buyer for the U.S. operations of Silicon Valley Bank. That's why she was saying there was no buyout. Again, the woman's dumb as a box of rocks. There's no buyers that came forward. Like I said, hedge funds were saying we'd pay 60% or something like that. Other companies weren't going by the goodness of their heart. Oh, we'll come in and help you. No big deal, blah, blah, blah. They're all like, okay, if we can make some money on this, we'll do it. Otherwise, we're running fast and furious away from this. So what was the government solution? What was the Fed solution? To come up with some new bullshit program, all right, called the Bank Term Funding Program. And what that is the Fed, the government, okay, and yes, I know the Federal Reserve is a private entity, but they get their money and their marching orders from the government. So one and the same. Anyway, the Fed is going to loan money to banks to keep them solvent. Again, where does the Fed get that money? They either take it from us, they borrow it from China, or they print it. Okay? There ain't any other options. What's the Fed going? How is the Fed going to loan this money? Well, it'll be based on the collateral that a bank can put up. Specifically, what they want is things like treasuries, agency debt, or mortgage-backed securities. Yeah, okay. Remember Freddie Mac and Fannie Mae? Yeah, those are mortgage-backed securities. Or how that turned out in 2008. So this is another situation of we're going to cause the problem and then we'll be the solution. Why did Silicon Valley Bank basically go under or couldn't meet their obligations when people were taking out the cash out of the account? They had 57% of their money in treasury bonds, long-term treasury bonds that they bought when interest rates were around 1 and 2%, okay? While the Fed raised rates so much, now we're up, bouncing around 4.5, 5 on a 30-year note, that the value of those bonds is down in the 80s somewhere, 800 something instead of $1,000 per bond. So the bank lost 18, 20%, something like that, in the value of their collateral. And nobody would buy it on the open market. Again, why would you buy 1% paper when you can go out and buy 5% paper, or 4.5%, or whatever it is right now, okay? You wouldn't. So the Fed is saying, we'll let you borrow against that paper that you have, those long-term notes that have a crap interest rate right now, and you have a year to pay us back. So the price of the bonds went down because the Fed raised rates, and now the Fed's going to say, well, we'll save you by loaning you money on it. Okay, do you honestly think the Fed's going to charge them whatever the interest is on the Treasury? No, they're going to charge more. Okay, so the bank, it's compounding a problem. This is only going to put banks further behind. Get it? Okay. So what will the bank have to do to pay off this loan? Oh, they'll have to raise the fees on you and me, okay? Which means, again, it's not based on interest rate because that's different, but they'll raise the servicing fees, the loan origination fees, the NSF fees, anything like that they have on their accounts, So, yeah, we're paying for it no matter what Janet Yellen says. Now, the funny part is, and I agree with this part, is they are going to make the depositors whole, all right? Supposedly, by putting this together, the depositors, the companies or the individuals that had money in the bank will have access to 100% of their funds come this morning. That's a good thing, okay? Because it's not the depositor's fault that the bank was completely mismanaged. It was the bank's fault. So by doing all this with this bank term funding program, what they're actually doing, because this is the other thing they're saying, is they're going to fund this by fees that the Fed is going to charge all banks, which means it's all going to roll down to all of us. Okay. But what they're doing is bailing out the irresponsibly run bank by charging more to the responsibly run bank. Mind you, this Silicon Valley Bank was completely woke. You had diversity hires hiring other diversity hires. You didn't have any competent people in there. The bank themselves should be totally screwed. The depositors, no. Okay. The stockholders, the bondholders, they're left holding the bag. They got nothing coming back. Okay. They lost their ass on it. That's it. Give you this, a year and a half ago, Silicon Valley Bank stock was trading over $700 a share. Today it's worth $0. You lost your ass. Okay. Now, you also had Signature Bank yesterday go under in New York. All right. And so this makes 3 in two business days and a weekend. What do they all have in common? They have, at least 2 of them have heavy investment in crypto, and one has heavy investment in technology. The funny part is, at least to me with all of this, is Your typical Bitcoin buyers are the ones who, not that anybody likes the Fed, but typically hates the Fed. Oh, the dollar's dead, blah blah blah. The future is Bitcoin. The future is Bitcoin. It's all going to be digital. This is all you hear from crypto fanatics, right? Until the banks that finance the clearinghouses and the wallets and stuff like that have trouble, and then they're like, "Oh, Fed, please come bail us out." That's the logic of millennials and liberals and stuff like that. It's the same thing as the defund the police. We need to get rid of the police. We need to get rid of the police. They're being mean to me. Call the police. Wait a minute. You wanted to defund the police. It's the same thing here. Okay, this is it. It's the old NIMBY principle. We hate everything until it affects us. And then all of a sudden we want that exact thing back. I got robbed. I want to call the police, but you wanted to defund them. I hate the Fed. Well, the bank that handles your crypto's gone under. We need the Fed to come bail us out. Anybody see the problem with that one? Yeah. Okay. So let's take a look at what's going to happen this morning. All right. And one of the reasons I waited for this, I wanted to see how the market reacted overnight. All right. So as of when I went to bed last night, somewhere around 10 o'clock, Dow futures were up about 300 points. As of right now, 5 o'clock, they are up about 150. So they're coming down. The dollar index is down 2/3 of 1%. Okay, so you'd expect to see gold and silver rallying. They are. Silver's up, 1.6% right now, and gold is up 1%. Okay, so you can expect to see something like that. Do we see bank runs this morning? Okay, don't know yet. Okay, won't find that out until the banks start opening up this morning. Market doesn't open up till 9:30 Eastern, so we're not going to know how the response is there. But, we'll probably see some downward pressure on the bank stocks. Now, I want you to look at something here. I'm going to show you a chart. This is the worst performing stocks on Friday. Okay, just Friday. This is how they perform. Take a look at this chart. The worst performing stock on Friday was Signature Bank, down 23%, 22.87. What happened over the weekend? New York regulators shut down Signature Bank. Okay. Next one's DocuSign. Okay, they're not a financial services company or anything like that. One we haven't heard about yet, and this is one you might want to pay attention to. Not saying I have any inside information or anything like that, just a bank to watch if you've got accounts there. Western Alliance Bancorp, they're based out of Phoenix, okay? They were down nearly 21% on Friday. They are heavily a retail bank. Money back and forth to you and me. Down 20.88% on Friday. The bank came out on Friday afternoon, and posted a addendum, if you will, to their quarterly reports saying, we're solvent, everything's okay, here's our deposits, et cetera, et cetera, et cetera. So they were trying to do damage control beforehand. Watch this one. If there is another shoe to drop, this one could be it. Okay. What's the next one on the list? First Republic Bank. How many of us have been talking about this one? This is another Silicon Valley bank where you saw all the videos over the weekend of people standing in line 100 deep to get into the bank, pounding on the doors saying, we want to get our money out. Okay. This is what you're looking at. One that went under, one that people are already started a bank run on, First Republic Bank, and one nobody's talking about. Pay attention to that one. That one could be the one that winds up in the news. I'm saying it is, but it's definitely one to have your radar up on. Completely different business model for a bank, but that doesn't mean anything right now. Because remember this, when bank runs start, they wind up a domino effect. If everybody starts pulling money out of a bank, just like happened with SVB, the banks don't have the cash to meet their obligations. Now you have a problem. So pay attention to this. One thing I want to remind everybody here on is the safety of what you have in banks. A few questions came up on this yesterday. Okay? And you've heard me say last week, have your money in multiple banks. I want everybody to understand something. FDIC insurance that everybody knows. First off, FDIC can pay like $1.70 on every $100 you have. Okay, so just give you this. It's like 1.7%. You lose $1,000, you can expect to get $17 back. Okay, they have 99 years to pay you. That's how solvent the insurance company you have is. All right, imagine your house insurance like that. Oh, your house is worth $100,000. Great. You know what? Here's $1,700. Have a nice day. What's that going to pay? A month's rent? Maybe. Not going to rebuild your house. Understand this on FDIC. You have $250,000 of insurance per institution, not per account, okay? You can't have a $250,000 CD and a $250,000 checking account and a $250,000 savings account at the same bank and be insured. You're insured for one of those. The other $500,000 in my example is uninsured. It's $250,000 per institution. It's actually per investor, per institution. So if you had a joint account, each one of you guys is up to $250,000, just saying. Okay. Not that a whole lot of us have this problem that we have more than $250,000 in a bank, but some people do. All right, so I'm just telling you that first off. The second thing is people want to know what is affected. CDs are no different than a checking account. That is a deposit, okay? That is susceptible to FDIC insurance. That is susceptible to bail-ins. That is susceptible to everything else. A few of you guys have asked me about trusts. Trusts is something that you have to talk to your attorney about. There are millions, well, not millions, but there are a lot of different kinds of trusts to see, how susceptible you are to anything like that. Stocks, bonds, mutual funds, anything like that you hold through your bank, okay, those are not FDIC insured, guys. Just telling you, all right, none. There is no insurance on anything like that. Those go up, those go down, those go whatever, all right, done. Again, I'm going to go back to what I have said many, many times. Prudence says have 6 months worth of bills in cash at home. Okay, and I know, let's say your bills are $2,000 a month. Okay, that means $12,000 in cash sitting at home. Yeah, I know it's a lot. Buy a safe. Simple. Okay, but one day, and it could be today, we don't know. We'll see what happens in a few hours. There are going to be bank runs all over the country, and the banks are going to topple like dominoes. This is what happened in 1929. There were bank runs, and the stock market crashed. People went to the bank. The bank didn't have any money. The bank closed the doors, and people said, I don't have any more money. The bank said, I don't have any more money to give you. We're out of business. And that was it. Okay. History repeats itself, guys. May take 100 years to see it, or 94, but are we on the verge of another Great Depression? Not exactly the same way, but Biden sure is hell-bent in destroying this economy. Could this be what they're trying to do to install CBDC? Twists and turns and government takeovers, and let's go after the mid-sized banks first to see how that works, and then we'll go after the big ones. Again, like you guys have all said on many things, this is all planned. Sometimes their nefarious plans get assisted by the stupidity of companies. Running your business according to woke ideals is a stupid idea. It's a good way to go out of business. Get woke, go broke, rears its ugly head every freaking time. This is just one more example. Have a good one. Pinball out.